So here's something that nobody expected. Things are heating up again in India's ride-hailing space because Rapido has launched Rapido cabs to take on Uber and Ola. So the story really begins back in October of 2023 when Rapido started their cab service pilot in Hyderabad, but today they claim to have already onboarded more than 1 lakh drivers onto their platform across Delhi-NCR, Hyderabad and Bengaluru. And if you've been following this story, there's one interesting detail that I think a lot of people seem to be fixated on, and I'm going to talk about it here and explain it a little bit, which is that Rapido is not taking any commission from their drivers, or at least that's what they're saying. That's how they're framing their business model. So the way that Uber and Ola work is with dynamic commissions. That's how they've built their business model. You book a cab, you pay the driver for your ride, but then Ola and Uber charge a commission on every ride from these drivers, and these commissions can actually be pretty high. This leads to reduced and often uncertain earnings for these drivers, whereas Rapido has a different model. So the way that their platform works is they let drivers take everything that they make on a ride, and instead of charging a commission, instead they charge a subscription fee for these drivers to access their platform. Now, there is a bit of nuance here, and this is where things start to get interesting because these subscription fees are dynamic. They do fluctuate depending on how much drivers are earning. And this is kind of confusing, right? What is the real difference between Rapido's model and Ola and Uber's models? They really look quite similar. So I'll use Netflix as an analogy here to try to illustrate how this works. So I'll start with Rapido first because it's the easiest to understand. So just like with Netflix, there are tiers. So for example, with Netflix, if you're one person watching on mobile devices in 720p, you're going to pay one price. If you're multiple people and you're watching on your TV in 1080p, you're going to pay a different price. If you want your videos in 4K, you're going to pay a different price. Same thing with Rapido. So the pricing does fluctuate as these drivers earn more money. If you earn 10,000 rupees in a month, you're going to be charged 500 rupees as a subscription fee. If you earn more than that, then the subscription fee will increase, and that's how they're framing it. Now, moving over to Uber and Ola, try to imagine if you're watching a series on Netflix and you're getting charged for every single episode that you're watching. And not only every episode, but maybe even every megabyte or every gigabyte of data that you're consuming on the platform. So that's kind of how Ola and Uber work. Every time a driver completes a trip, they're paying a percentage to these companies. And so I hope you understand the subtle difference between these two different models, because now I'm going to explain why this is significant. See, the problem for Rapido and the reason why they're moving in this new direction is India's focus on EVs. India is pushing to have EVs everywhere. In fact, recently, the Delhi government came up with the Delhi Motor Vehicle Aggregator and Delivery Service 2023 scheme, and they want fleet aggregators and delivery companies to only operate electric vehicles by 2030. And I wouldn't be surprised if more states across the country follow in Delhi's footsteps. And so this could cause a lot of trouble for Rapido. However, with this subscription-based model, it might not be a problem for them because according to Rapido's founder, Pawan Guttupalli, the scheme only applies to aggregators, but Rapido is technically offering a SaaS platform for its drivers. In other words, this scheme wouldn't apply to them, and their drivers who are on their platform wouldn't need to go out and buy EVs, which would be a significant hit to their business. And I think that they're hoping that their unique commissionless model is going to help them to take significant market share from Ola and Uber quickly before the government catches on and puts in a new policy to include Rapido in this scheme. But in the meantime, they're trying to also build partnerships with companies to transition their existing vehicles into EVs as well to prepare for the inevitable future. All right, next up in the news, it is official. The door is finally closing. ZestMoney is shutting down by the end of December. So what went wrong? Because up until last year, they were actually one of the leading players in the BNPL, that's the buy now, pay later category, and they were valued at $450 million at their peak. Well, firstly, in June of 2022, the RBI issued a notification that pretty much killed the BNPL category after it stopped non-banking fintech companies from loading e-wallets and cards with credit lines. Then in November of 2022, the company tried to be acquired by PhonePe, but that fell through after PhonePe cited due diligence issues, and then the company had to lay off 20% of their workforce as they tried to survive and rebuild. But things only got worse after all the founders decided to quit in the middle of all of this chaos in May of 2023. Very bad timing. And there was still a little bit of hope with ZestMoney's board announcing ZestMoney 2.0 to script a turnaround, but that hopeful turnaround is not coming, and the company has decided to shut down whatever's left of its operations by the end of December of 2023. And unfortunately, that also means letting go of the remaining 150 employees that are still at the company. All right, next up in the news, but continuing to talk about lending, Paytm has decided to scale down its small ticket lending, basically anything below 50,000 rupees through its postpaid business. And here's the thing, this could actually significantly impact the company. See, Paytm's lending business has been one of the key reasons for their turnaround story. In the second quarter of FY24, Paytm had dispersed loans worth 16,211 crore rupees. And out of this, 9,010 crore rupees were lent through their postpaid business, and 70% of their postpaid loans are actually less than 50,000 rupees in value. According to the company, this decision will lead to a drop of between 40 and 50% in their postpaid loans business. But the question is, why? Why are they making this call? Why would Paytm choose to scale down on a business that has helped them to grow and strengthen their company? Well, the reason is the RBI. See, these types of loans are what you would call unsecured loans, which means that you can get them without having to give any collateral. But what happens when a person takes one of these loans and they're not able to repay it? Well, since there's no collateral, the banks can't do much about it. They have to absorb this loss and move on. And that's why last month, the RBI decided to put out a notification which essentially made this type of lending more expensive for companies like Paytm, and it worked. See, Paytm works with other NBFCs to disperse these loans, but when these partners saw that these loans were getting more expensive to offer, basically they asked Paytm to slow down, and they also want Paytm to be more cautious. And there's nothing that Paytm can really do in this situation if their partners are unwilling to give them money to lend to users, but this is really not a good situation for Paytm, and after steady growth in their stock price, they saw a 20% drop after this announcement. All right, next up in the news, things are going well for Unacademy. Last year, Unacademy had to fire 1,000 employees as their business was inefficient, according to Gaurav Munjal, and he decided that instead of focusing on multiple verticals, they would go back to basics and basically just focus on their core test prep business. And it's been over a year since they started to make that transition, and things are looking much better for the company. So Gaurav Munjal took to X to share some of the insights. So Unacademy's newly started offline centers that are focused on test preparation only had about 6,000 students at the start of 2022, but now that number has grown to 32,000 students in 2023, and on the other hand, their online business actually shrank by 30%. However, thanks to their focus on offline test prep and cutting down on unsustainable verticals, their EBITDA improved by 87% and their cash burn has been reduced by 60%. Today, Unacademy has 1,800 crore rupees in the bank, and this money can keep the company going for the next 4 years. So you might remember last month there was this glitch on Zerodha's stockbroking platform Kite where users weren't able to see their executed trades. But now the platform has suffered another glitch on the 4th of December, and this time 5 to 20% of Zerodha's active users were affected, and they weren't able to log into their accounts due to a technical glitch. This happened after there was an update to Zerodha's IP address database which changed the recorded location of users. And because of this changed location in their database, as users were trying to log in, the location in Zerodha's database for where that user was supposed to be and where the user actually was didn't match, and so these users were being sent an email to update their passwords. And so many of them tried to update their passwords, but they were all doing it at the same time, which of course took a toll on Zerodha's system, and it caused this glitch where basically things crashed. And no matter what the reason is, this is a bad sign for Zerodha just after they were overtaken by Grow in terms of the number of active users on their platform. It seems like a lot of people are making a conscious choice to trade on Grow rather than Zerodha, and these glitches aren't helping Zerodha win any points with their users. All right, next up, let's move on to the funding news this week. So Indian startups raised a total of $89.7 million compared to $59 million last week. So let's take a look at some of these companies. First of all, we have an Indian generative AI startup headquartered in Bengaluru, Sarvam AI. These guys are building LLMs, large language models, to support Indian languages, and they've raised $41 million in their Series A round. After that, we have Mumbai-based D2C mattress startup The Sleep Company. They raised $22 million in their Series C round. Then we have Gurugram-based cloud kitchen startup Biryani by Kilo, and they raised $9 million also in their Series C round. And then we have kind of an interesting one, Bengaluru-based specialty chemical manufacturing startup Skimplify. They raised $3.6 million in their seed round. And then finally, we have Gurugram-based IoT-enabled wastewater management startup Digital Bunny, and they raised $1.2 million in their seed round. All right, that's all I've got for you guys this week. I really hope that you enjoyed the video, and I will catch you in the next one.